Hello, everyone. This is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So here on Money Minutes, I share with you some of the latest market headlines and my outlook for what's ahead. So for this week's episode, I'll cover the latest PCE report, which stands for Personal Consumption Expenditures. This is the Federal Reserve's preferred gauge for inflation. I'll also talk about the overall stock market, which recently hit an all-time high. I'll talk about why that is and my overall outlook. So let's get right into it. So the May PCE report was just released. This stands for Personal Consumption Expenditures, and it tracks the changes in prices that consumers are paying for goods and services across the country. This is the Federal Reserve's preferred gauge for inflation, so they pay very close attention to what's happening here as they look to decide what to do with interest rates. Now, with the exception of January, the rest of the year we've seen PCE actually cooling. So this has really been antithetical to what we've been expecting with tariffs, right? With trade tariffs, traditional economists were expecting prices to rapidly increase. So far, we've seen inflation decreasing. Well, things changed for the month of May. We actually saw prices increase a little bit. Now, it was in certain areas, for example, food services, accommodations, clothing, durables, rents, for example. So certain areas you saw price increases. Some areas you saw either flat prices or declining. Those would be an area, for example, like autos. And autos is an interesting section because when we looked at April, there was an uptick in auto purchases. And the reason for that, many speculate, is because people were trying to get ahead of tariffs by making those bigger purchases before the tariffs kicked in. Now, as we're heading into the later months, that consumer demand is starting to slow down. People aren't buying. Maybe they already took care of a lot of their purchases earlier in the year. And so we're seeing softening demand. That was another area of this report that showed a weakness, which was consumer spending overall has declined. That is typically not a good sign for the economy either. It shows a weakening economy. So slightly higher than expected inflation, weakening consumer. It definitely wasn't a great report, but the market didn't have an overall negative reaction to this, mainly because it wasn't terrible, right? With all of the tariffs and everything going on, it wasn't a terrible report. And really, it's just 1 month. And so, as we've talked about before, even the Federal Reserve, they don't base their decisions on one report or 1 month of data. They want to see a trend. So far, the trend has been relatively good for the year. Inflation is actually cooling. But if we get another bad report, like for example, on July 15th, we're going to get the June CPI report, which is another inflation tracking report, the consumer price index. If that also comes in higher than expected, if we get weak job numbers, if we get other weak, for example, soft data like consumer sentiment or manufacturing surveys, this could really start to affect the Federal Reserve's opinion of the overall economy. The Federal Reserve is already relatively hawkish. Fed Chairman Jerome Powell recently, he's been grilled by Congress as to why he's not cutting interest rates. And his opinion, and many of the other members of the Federal Reserve, they believe that the impacts of tariffs on inflation, notably, are likely to materialize later this year. So they don't want to start lowering interest rates, which is also inflationary, if there's this impending increase of inflation that's supposed to happen later this year. So they want to wait and see to see if prices actually do go up before they just start lowering interest rates. And so it's a very conservative approach that the Fed is taking. But reports like this bolster the Federal Reserve's approach and really hurt members of Congress or the overall federal government who are calling for lower interest rates. And so my overall view on this is it's one report. Let's see what the next few reports tell us. If we do see inflation, start to accelerate, that's a cause for concern. That shows us that the Federal Reserve may not cut interest rates. For example, this report here likely takes a July rate cut completely off the table. And so according to the CME Fed Watch tool, the most likely next few rate cuts are going to be in September, There's actually a projection for a cut in October and December as well, which is pretty new. So 3 rate cuts, 25 basis points. This number has shifted all over the place this year. Prior to the beginning of this year, of course, before these tariffs were announced, there was a joyous opinion in the market from economists that the Federal Reserve will finally begin aggressively lowering interest rates, maybe even doing as many as 5 rate cuts this year. And so the market was boosted basically on that outlook. And then as the tariffs were kicked on, the Federal Reserve did a complete 360 and said, look, we're not sure about cutting interest rates this year based on these tariffs. And so then the market had a reality check based on that. And now we're slowly getting more and more reports to see what exactly is the impact of tariffs. Now, I've talked about in previous episodes, there are a lot of issues with tariffs. Number one, it's not very clear exactly what products are affected by tariffs. You see lots of headlines, but we don't really see what's happening in the customs departments and what's actually being tariffs. And then there's also a lot of legal issues too. For example, courts have tried to strike down the tariffs, and then one court did, and then it was appealed, and then the judge allowed the tariffs to go back on. As you can imagine, if you're a customs agent going to work, trying to figure out what tariff to apply to what product, work can be pretty confusing. And then in addition to that, there's all these different sections in the trade rules of what to tariff and how much to tariff, and certain countries that are getting exceptions, certain products that are getting exceptions. My guess, based on historical precedent, is that the tariffs aren't being implemented exactly as they should be. And that's a good thing for the economy because it's probably delaying the negative impact of these potential inflationary effects of tariffs. And then as you have potential trade deals coming up, this could completely eliminate the possible risk of major price increases. Now, I'm not saying that we are going to completely avoid any inflation at all. Actually, I think the main negative impact of these tariffs are going to be the fact that we're not going to get to 2% inflation as quickly as once projected. It's going to slow down the reduction of inflation. It's not going to slow down fast enough to 2%. Now, what this does is this delays rate cuts, right? So if the stock market is expecting rate cuts and it gets delayed even further, like for example, if the September cut doesn't happen, there will be some adjustments to valuations. If October and December don't happen, even more adjustments. Like if we don't get any rate cuts this year, this could have a pretty negative impact on the stock market. It could have a negative impact in capital markets activity overall, IPOs, private equity. This part of the market is waiting for lower interest rates to increase deal activity. And so lowering interest rates is so important. Then you've got even the real estate market, which continues to have a difficult time in this higher rate environment. So overall, there's a lot riding on the Federal Reserve lowering interest rates. But this depends on what happens with tariffs and trade deals and the implementation of tariffs. And so my overall outlook remains that tariff implementation is hard. Trade deals are more political noise than they are actual economic impacts, right? And so I wouldn't be shocked if we go down a few more months and we still have relatively muted inflation reports. And you're going to hear from a lot of pundits, well, this wasn't what we expected, and we expected things to be a lot worse. And even one of the top analysts at Apollo Global Management, a very respected firm, recently came out and said, look, I think we may have been wrong. And I'm paraphrasing, of course, but they initially came out with a very bearish report saying, oh my gosh, these tariffs are going to cause serious problems in the economy and potentially a recession in the summer. And then now as some of the other data is rolling in, clearly we're not in a recession. Maybe they're changing their tune a little bit. And so the Federal Reserve's wait and see approach, I think, is justified. And we really are going to find out over the next few months what the impacts of tariffs really are. And this will have a resounding impact across client portfolios. Stocks, bonds, private assets, everything is impacted by the decision of the Fed to lower interest rates or to keep them where they're at. Now, if inflation completely goes the other way and starts increasing dramatically, you could very well have the Federal Reserve raising interest rates. Now, that, of course, is the most unlikely outcome at this point, but it remains a risk. So the latest update I have for you on inflation is that we did get a hotter than expected reading, but I wouldn't be too worried about it just yet. We have to see more reports, which I'll cover with you in future episodes. But that's the latest update I have for you on inflation. So the S&P 500 and the Nasdaq have recently hit an all-time high, and really it's a surprise to a lot of investors because just a couple of months ago, the market was down about 20% from its all-time high, and since then it has recovered about 24% from its lows. And so it's been a roller coaster ride the last couple of months, and really there's been a lot of negative headlines since then. And investors are really trying to wrap their heads around, how does this even happen? How does the market go through such a interesting cycle? And how is it even positive when we've got such incredible tariffs and a change in global trade policy going on, the impacts of which are still to be seen, relatively muted so far, but still to be seen. You've got the Federal Reserve, who went from potentially cutting interest rates 5 times this year to not cutting interest rates at all so far. And it's not like they've agreed to cutting interest rates this year. We could get zero rate cuts. I know in my previous segment, I talked about the current expectations, but that could shift if the reports come in with higher inflation than what was expected. So you've also got, of course, continued trade tensions. I mean, even after market hours today, I'm recording this on Friday, June 27th. You've had the president announce that they're going to cease their trade negotiations with Canada because of a new technology tax that they're implementing. And so there's a lot going on still, and yet the market continues to keep moving forward. And so clients are wondering, how is this even possible? Well, the overarching reason for that is uncertainty has come down meaningfully. When the tariffs were announced, those tariff rates were very high. And then, there was a lot of back and forth with China. Those rates got even higher and higher to a point where it was pretty ridiculous, and it was not sustainable for either country. Well, since then, those tariff rates have come down. There has been pauses put into place, like the 90-day pause, for example. Some countries there's been tentative deals with, so those tariffs have come down a lot since then. And so you've got this reduction of overall risk as it relates to trade policy. We're not completely out of the woods yet. There's still a deal with China that's supposedly signed, but we don't have the details of it yet. As those details come out, that's when you get even more positive, I believe, impact in the markets. You've also got a deal with India that's supposedly going through their parliament. We still don't have the details with that yet, but those are two major economies. And many other deals that are floating around out there, Japan, South Korea, and many others. And so there's still potential catalysts out there for the markets, but things can go the other way too. Those deals could all fall through, just like the one with Canada recently fell through. So still a lot of risk out there, but investors are feeling more confident. As it relates to inflation overall, immediately after these tariffs were implemented, there was so much negative sentiment out there. Inflation is going to skyrocket. Grocery stores are going to be completely wiped out. Go and buy all of your things now, because by the time, in the summer, we're going to be in a recession and everything's going to be so much more expensive. Well, some of those concerns have not come to fruition, thankfully, and investors have realized, maybe it's not going to be as bad as we thought. Now, the Federal Reserve is taking a bit of a different approach to that. They're saying, look, there will likely be more inflation, but it'll probably take place later in the year as the impacts of tariffs flow through into the economy. So we'll have to see what happens as it relates to that. But overall, with a reduction of geopolitical tensions, the war ending in the Middle East, the war in Europe, at least there's some resemblance of negotiations going on. These are positive factors. Trade policy improving, positive factors. Economic reports. There's strong labor market still. There's some things to be happy about, despite all of the ridiculous, crazy headlines that are floating around out there. So overall, that explains why, for the most part, the market is doing really well. And, the S&P 500 and the Nasdaq are both extremely heavy in technology, and artificial intelligence continues to power this market through. We're seeing great news from companies like Microsoft, Amazon, Nvidia, AMD, and others that are coming out with brand new breakthrough, whether it's new chips, whether it's significant spending, commitments to spending a lot of money on AI infrastructure. There's a lot happening in the artificial intelligence space as well, which is propelling the markets forward too. And I believe this AI advancement will continue. That's been the thesis for a while. And I'm very happy to see all of the things that are going on with artificial intelligence right now. So there, in my view, will be a tale of two markets this year. You've got the first half, which was really tough, really volatile. And then you've got the second half, which I'm still rather optimistic about. I don't think it'll be as bad as some economists are projecting. I think there's certainly a sect of very bearish economists out there. And then there's those that are more in the middle saying, look, tariff implementation is very tough. You've got trade deals that could potentially go through. I don't think every single major trade partner we're going to have a deal with soon, but I think we're going to have some, and that's going to take the steam off of some of these negative tariff impacts. And so taking that more neutral viewpoint when it comes to things like this is going to be, I think, a very positive way to look at the market, which is why I believe that we're still going to have a great stock market year. And I expected it to be very tough in the first half and to see a bit of a recovery in the second half. Now, again, there's a lot riding on that theory. If the Federal Reserve sees some hotter inflation reports and decides not to cut interest rates at all, that's a bad thing. If the Senate or the House decide that they can't come to agreement on this tax bill that's going through, that's going to be a tough thing as well, because that means higher tax rates for everybody going into next year. That's not going to project well going into the stock market. So there's a lot to pay attention to as we get into the second half of the year. But this explains why the market's propelled forward so far. And we still need to see some more advancement in a lot of those areas that I discussed to get even higher levels in the stock market. But I don't think they're out of reach. I still have an optimistic view of what's going on, and we'll be paying very close attention to what's happening in the market. So hopefully this explains why we're at all-time highs, what's going on. And if you have any questions about anything discussed in today's video, please don't hesitate to reach out. Thank you very much.